Hello everyone, thanks for checking out my video. What a crazy and volatile week we had. At one point, the S&P 500 fell over 3% in its biggest post-FOMC meeting drop since March 2020, wiping out more than $1.5 trillion from the stock market. Dow Jones index closed in the red zone for 10 days in a row, clocking its longest losing streak since 1974. This came after the Federal Reserve delivered a so-called hawkish rate cut. However, by the end of the week, all three major indexes rebounded more than 1% as cooler than expected PCE inflation data helped to stitch a mini comeback. With this, the burning question on everyone's mind right now is whether we will see a Santa Claus rally this year. Let's discuss this topic in this video. As always, do watch on to find out more. Alright, the stock market ended on a high note last week, but it was a tough and volatile week. It all started when the Fed delivered a hawkish rate cut after the FOMC meeting. So here's what happened. The Fed announced a rate cut of 25 basis points on Wednesday, 18 December, which was in line with market expectation. But what shook the market was the Fed's outlook for 2025, which shifted towards the hawkish direction. The Fed had revised their 2025 outlook from 3 rate cuts to 2 rate cuts, totaling 50 basis points. At the same time, the Fed raised their PCE inflation expectation from 2.1% to 2.5% at the end of 2025, well above their 2% target. This evidently shows that the Fed has acknowledged that inflation is still a problem. To add on, Chairman Jerome Powell was pretty hawkish in his press conference as he said, "I think from here it's a new phase and we are going to be cautious about further cuts." Not just that, he also described the latest rate cut decision as a closer call, which seems to be telling the market that the Fed is actually a little hesitant in cutting interest rate. This hawkish speech sent US stocks tumbling, the US dollar rallying, and the fear and volatility index VIX spiking. By the end of the day, the market saw the biggest panic sell since the yen carry trade collapsed in August this year. Fortunately, the market then received some good news towards the end of last week. So on Friday, 20th December, the latest PCE index, which is the Fed's preferred inflation gauge, came in softer than expected. Specifically, November's PCE inflation rose by 2.4%, falling short of the estimated 2.5%. Similarly, core PCE inflation came in at 2.8%, below the market expectation of 2.9%. These positive inflation figures have helped to calm the market and diffuse some of the bearishness that was induced by the Federal Reserve. For the upcoming week, it is going to be a holiday shortened trading week, with the market closing early on Tuesday, which is a Christmas Eve, and will not reopen until Thursday's Boxing Day. With no notable earnings on the card, this coming week could see investors still figuring out how to react to what is seen as a newly hawkish tone from the Federal Reserve, which has signaled fewer interest rate cuts in 2025. On a side note, one positive news for the week ahead is that at the time of recording, the US government has avoided yet another potential shutdown. This could potentially remove some uncertainty and jittery in the market. Last but not least, with this being a short week and the festive season in full swing, market volume is likely to be low, which means volatility could be high because fewer participants in the market allow a few big players or trades to significantly influence price movements. Okay, let's now jump over to the technical analysis segment and have a look at SPY's chart. Check out the big red candle that was formed last Wednesday after the FOMC meeting. It basically breached 3 Fibonacci retracement levels in a row, including the common bounce area of 50% Fibonacci level. That's obviously bearish, but here's a saving grace. The bulls managed to defend the all-important 61.8 Fibonacci level at around 581. This level, in my opinion, is considered a pivotal level. As you can see from the chart, it used to be a level of resistance where SPY found it difficult to break above. And now that it is above it, it has acted as a strong support recently. To put it simply, watch this level from now till the year end. If we want to have a center rally, this 581 level obviously has to hold, because if it doesn't, I do think there is a high probability that we might feel that gap between 574 to 580. Honestly, if we ever fall to 570s range or even 560s range in the next few weeks or post-center rally, I would be excited to hunt for discounted stocks. On the other hand, if the critical 61.8 Fibonacci level continues to hold this week, then the center rally could be in play and we could likely reclaim the 600 landmark level again. Above 600, it will put us into this mini consolidation zone between sub 600 to 607. The longer we form a base here, the higher the chance of another all-time high in the next few weeks. Okay, let's have a look at Apple's chart, which looks pretty straightforward to me. Apple has been moving in this mini consolidation zone between 246 to 255 for about 2 weeks already. The bottom of this zone, in other words 246, is a support level to watch if Apple retraces this week. If 246 breaks, there is really not much support till 237, at least in my opinion. I know there is a 38.2 Fibonacci retracement level at 241 which could act as a support, but my view is that if the market makers want to flush, the target will be 237. And 237 is one huge strong support formed by the 50% Fibonacci level and the blue line that I previously drew. This level has proven to be a tough resistance level in the past, which means it should be a tough support level now that Apple is above it. Given how Apple has been doing shares buyback and that the end of December has been the traditionally strong period, I think it's quite unlikely for Apple to go below 237 these 2 weeks. On a side note, watch that MACD closely. It seems like it wants to have a bearish cross. If it materializes this week, then it means Apple is pulling back. So watch out for those support levels that I have just mentioned. On the other hand, if Apple continues to surge higher or retraces to only the first Fibonacci support level and then bounces up, the sky is really the limit. I mean, there's almost nothing to chart or talk about above 255 in terms of technical analysis. It will just be all-time high again and again, which Apple has been doing until the overall market sentiment changes. Moving over to Tesla. So in my last video, I mentioned that Tesla had more room to go, but such melt-up will eventually fade off when FOMO investors and shorts are done snapping up the shares they needed. The only question is we don't know when. At the moment, we can't be sure if this is the end of the parabolic run, but we did have a bit of pullback last week. From the recent closing high of 479.86 to the current closing price of 421, that was a 12% drop. Okay, for this week, watch the MACD closely. If it starts curling down, I would think Tesla could break below the psychological support level of 400. I must say this 400 level is one huge level that the bulls have to defend. Once this level gets breached, I wouldn't be surprised if Tesla moves very quickly towards the 38.2 Fibonacci level at 383. Without me saying below 383, the next target is obviously 350, where the 50% Fibonacci level is. Well, I know it may sound crazy and scary for Tesla to drop from the current price of 420 to 350, but if you do the math, that's only a 17% drop. I mean, it's Tesla. It can fall and climb 8 to 10% in a single day, so 17% means nothing in Tesla's context. Furthermore, if you can take the 100% right up over the last 6 months, you must be able to stomach a 20% drop anytime. Okay, before you get all too scared, I would like to clarify that I'm not saying Tesla will hit 350 this week. In case you didn't catch my gist, what I meant was to watch for the potential bearish cross on MACD and 400 support level if the retracement continues this and next week. And if 400 breaks, there is then a chance for Tesla to head towards 350, but it may not be this week. In terms of the bullish thesis, we need the MACD to reverse back up, or at least to hold up, something that we saw back in late November. Back then, MACD had a bearish cross, but it held on well by going flat, and Tesla's price went sideways too before we had a huge breakout. And so if that happens this time, the move up this time could be as violent as that time, which means we could see another all-time high or perhaps even go near 500. But once again, all this may not happen in just 1 week, so watch those key levels and indicators closely. More importantly, stay subscribed to my channel for more updates as we have a few key catalysts coming up for Tesla in the next 1 month or so, namely the delivery numbers, Trump taking office on 20th January, as well as Tesla's earnings in late January. All these events could spark fireworks in the share price. Moving over to Google's chart, if you could recall, in my last video I shared that the recent pop in Google's share price was a result of their new quantum computing chip, and such news-driven rally is not sustainable. And well, Google did hit all-time high last week but retraced a little bit by the end of the week. Okay, for this week, in terms of the bearish thesis, watch for two support levels, and they are 182 and 178. These are the important Fibonacci retracement levels for the bulls to protect if they want the current bullish momentum to continue. If both levels break, I would expect Google to completely fill that gap between 176 to 181 and likely head towards the 50 moving average, which sits at 174. Honestly, any form of pullback will not get my attention until it starts going near or testing the 200 moving average at 167. This is one dynamic support level that has proven to be a very strong one for the last 12 months. So if it reaches here these few weeks, I would consider picking up some shares as well as selling put option. On the other hand, if Google can reclaim the first Fibonacci retracement level at 192, then I believe further bullish momentum or FOMO investors could step in to push Google towards 200 again. And near all-time high, or rather at new all-time high, the sky is the limit. Okay, hopping over to Meta's chart. Wow, the chart looks scary, isn't it? 7 consecutive red candlesticks. But if you had followed my last video, you wouldn't be too surprised by the latest movement. In that video, I shared that if the pullback continues, we can expect Meta to hit 604 at least. And when 604 breaks, there is a high probability of Meta heading towards 583. And Meta hit both levels last week. For this week, continue to pay attention to the 583 level. This is an important support level because it is where the 38.2 Fibonacci retracement level meets the 50 moving average, thus forming a double support. If it breaks, then Meta could go towards 566 very quickly. At 566, it has to hold, because if it doesn't, it means Meta could be back into this blue downtrend channel again. When that happens, I don't think I need to tell you that Meta is pretty bearish. Not offering financial advice, just speaking for myself, if Meta could drop a bit more towards the critical 61.8 Fibonacci level at around 550 this week, it could be an opportunity for me to pick up shares or to sell put option. Reason being, by then Meta could be hitting the oversold area and probably due for a small term rebound. Okay, in terms of the bullish thesis, same thing, watch for the 583 double support level and 566 where the 50% Fibonacci level is. This 566 is also right above the downtrend channel. If Meta bounces either level, it's considered bullish because it's doing a classic retrace, retest and rebound movement. For bullish confirmation, it needs to reclaim the 604 level. If we can put a few green candles above 604, I think Meta could easily hit towards 615 or perhaps even the 620s range. Moving over to Microsoft, I think there is no need for me to repeat what I have been sharing. Basically, above that blue uptrend line, it's bullish, and below it, it's bearish. Right now, Microsoft has fallen below the trend line, so it's bearish. This is reflected by the MACD where it had a bearish cross last week. Come this week, for Microsoft to resume its uptrend, it needs to get above the 38.2 Fibonacci level as well as the blue uptrend line. But by going slightly above it, it is not convincing enough. For us to call Microsoft bullish, it needs to reclaim that 444 level. If we can print a few nice green candles above it, the year-end momentum could push Microsoft above the recent high of 456. On the other hand, if Microsoft gets rejected by the trend line, watch for 430, which is the 50% Fibonacci retracement level. As you can see, the bears tried pushing it below last week, but the bulls managed to bring the price back up. But if the selling pressure continues this week and Microsoft starts closing below 430, the last line of defense lies at 423 to 426 area. This area is formed by the critical Fibonacci retracement level as well as the 50 and 200 moving averages. If this area breaks, I think we can likely say hello to low 400s range again. Personally, I wish Microsoft can fall to the 200 moving average area. I may potentially step in to either pick up shares or sell a put option. Again, this is not financial advice. Okay, let's check out Nvidia. So in my last two videos, I specifically mentioned that when 138 support level breaks, Nvidia could hit 120s range. And there you have it, Nvidia hit the 120s range. As also shared in my previous videos, it does take some courage to go against the hottest stock in town, but that's the thing about technical analysis. You ignore the FOMO crowd and hype up news. As much as you can, you try to objectively look at what the chart is showing you. I hope my bearish analysis of Nvidia warrants a like button from you. Anyway, for this week, watch the 129 level closely. That's one strong support level which the bears could not bring Nvidia below it last week. We tested this level 4 times, but right now Nvidia is sitting nicely above this 129 level. Interestingly, this level used to be a resistance level back in August this year, so I would say this level has turned from resistance into a support level now. Alright, staying above 129 is only the first positive sign. For Nvidia to be caught bullish or reverse its current bearish momentum, it needs to reclaim 138, where the 50 moving average and the first Fibonacci retracement level are. Above 138, then naturally, the door towards 140's range will open again. At 140's range, I wouldn't want to be holding on to any shorts positions. Talking about positions, I actually opened a slightly bullish option trade last week. More on that later. Okay, with all being said, always be prepared for the downside. If 129 breaks, then obviously it means Nvidia is still bearish. That's when you would want to pay close attention to two key levels or areas. The first one is the 50% Fibonacci level at 121, while the other is this 114 to 116 area. This is where the critical 61.8 Fibonacci level and the 200 moving average are. So if this 114 to 116 area breaks, it's waterfall time for Nvidia. You wouldn't want to be holding on to any long positions. Let's now jump over to the options trading section. I have 4 trades to update this week. The first 2 are this new cash secure put on Tesla. The first contract was sold on last Monday, 16 December with a strike price of $3.55, expiring 27 December. The second contract was sold last Thursday, 19 December with a strike price of $3.50, also expiring on 27 December. The reason for selling these 2 contracts was simple. If you have watched my last video, you would have known that I previously sold a Tesla put contract to earn some cash for the festive season. So it's the same reason for these 2 latest contracts. For selling both contracts, I received about $186, which is equivalent to around 250 Singapore dollars. What this means is that if Tesla doesn't crash from the current price to $3.55 or $3.50 by this coming Friday 27 December, both contracts will expire worthless. Which also means I will get to keep the full $250 premium without having to close the positions. Extra $250 for this holiday season, not too bad, right? Anyway, to be honest with you, there isn't much technical analysis behind both trades. If anything, it will be the 50% Fibonacci level. That's a typical and common bounce level in Fibonacci retracement context, making it a strong support area, which explains why my strike prices are near this level. And frankly speaking, there is really just one key factor behind executing these 2 trades, and that is time decay. In case you're not aware, options are decaying assets and lose time value daily. Think of it like holding on to ice cubes. They gradually melt with each passing second. Similarly, when you buy options, the contracts you hold lose value daily. In this scenario, I am the option seller. I am the one selling these ice cubes to buyers who will hold on to them as they continue to melt until 27 December, the expiration date. I actually talk about this ice cube theory in one of my options videos. Feel free to check it out if you have time. I have linked it at the top. And let's not forget, the upcoming week is a holiday shortened week with just 3.5 trading days. The market closes early on Christmas Eve and is entirely closed on Christmas Day. Fewer trading days mean fewer opportunities for Tesla to experience a huge crash. Next up, the third trade to update is this new cash secure put on Nvidia. This contract was sold last Thursday 19 December with a strike price of 110 expiring 24th January 2025. The thought process behind this trade was straightforward. Basically, Nvidia has fallen from 152.89 to 126.86. That's a good 17% drop. Its 6-day RSI value is hitting over so soon. As I zoom out the chart, you will be able to see that the last 3 times when the 6-day RSI hit or went near this level, Nvidia's price was higher 1 month later. To put it simply, Nvidia has plunged quite a lot recently and it is approaching oversold level. Therefore, I am expecting a short-term bounce or sideways movement, which it did. Nvidia rebounded 3% last Friday. To add on, I have managed my risk by choosing a strike price that is below 2 strong support levels. These levels are 129, where the 100 moving average and 38.2 Fibonacci level converge, as well as around 114 to 116 area, where the 200 moving average meets the 61.8 Fibonacci level. Alright, finally, here's the last trade to update, a Tesla cash secure put that expired last Friday 20th December. The contract was sold on 6 November with a strike price of $250. On that day, Tesla had a gap up after the market learned that Trump is going to be the incoming US president. This trade was a pure momentum play as I knew that such crazy bullish momentum will likely to continue for a while. More details about this trade can be found in the video linked at the top. Anyway, ever since I sold the put contract, Tesla rallied from 280s range to 480s range and came back down to 420s. As of the expiration date, which was last Friday, Tesla closed above my 250 strike price and therefore the contract expired worthless. With that, I got to keep the juicy premium of $600 without the need to close the position. Okay, moving on to the last segment of this video, my end thoughts. First of all, investors are facing some turbulent conditions this December amid what is usually a favorable period known as the Santa Claus Rally. In case you're not aware, Santa Rally refers to the last 5 trading days of the calendar year and the first 2 trading days of the new year, which means we are looking at a period from Tuesday Christmas Eve till 3rd January 2025. Since 1969, this Santa Rally period has given an average gain of 1.3% for S&P 500. But this year, there are some signs that Santa Claus may disappoint. I mean, we have a hawkish Fed, rising treasury yields, sticky inflation, and legislative uncertainty. All these create a challenging environment for stocks as the year concludes. Okay, but if you take a step back and look at the stock market performance in general, could it be a case where the seasonal strength or Santa Claus may have come early for the year, given the S&P 500 posted a strong return of 5.7% in November, driven by Donald Trump's presidential election victory early last month? Anyway, my personal view is that last week's pullback is a positive thing because it has cooled off the overheated and overbought market by a little bit. It has also brought some overly enthusiastic investors back to the earth as they face the reality that the stock market is pretty expensive and that the Fed can still cause the market to move against us. In fact, with the latest pullback, the market could be in a better position for a Santa rally than a week before. But to answer the question of whether the Santa rally will happen this year, all I can say is no one can predict the future with certainty. Well, statistically speaking, the odds are high and favorable, but I wouldn't bet everything on it. While I am optimistic about the market over the next 2 weeks, I am keeping my expectations in check. If the rally doesn't materialize, so be it, just have your shopping list ready. Okay, that's all for this video. Merry Christmas everyone, and if you found this video useful, do help to like the video and share it with your friends. Thank you.